When it comes to groundbreaking technology, few sectors attract as much attention and scrutiny as quantum computing. But here's where it gets controversial. Despite the immense potential of this futuristic field, companies like D-Wave Quantum Inc. are facing a harsh financial reality that has investors questioning whether the risks outweigh the rewards. With its stock plummeting by negative 6.46% in recent trading, D-Wave is at the center of a heated debate about innovation versus profitability. Let's dive into the details and explore what this means for the company, its shareholders, and the future of quantum tech. To understand the situation, we need to rewind a bit. Earlier this week, D-Wave Quantum Inc., NYSE, QBTS, reported worse than expected financial results for Q2, sending shockwaves through the market. Before the opening bell, shares dipped by more than 3%, signaling growing unease among investors. While the company managed to generate over $8.8 million in revenue, this figure wasn't enough to offset the gaping losses that have been piling up. Analysts are now raising red flags about the sustainability of D-Wave's business model, especially as liabilities continue to mount. This has left many wondering, can D-Wave's cutting-edge research justify the mounting financial strain? On Friday, August 15, 2025, at 16:03:25 EST, the stock was still trending downward by minus 6.46%. This sharp decline isn't just a reflection of poor quarterly performance. It's a symptom of deeper concerns about the company's long-term strategy. For instance, D-Wave's EBIT margin stands at an alarming minus 1254.8%, while its pre-tax profit margin hovers around minus 1034.5%. These numbers tell a story of a company struggling to reconcile its ambitious goals with the realities of running a profitable enterprise. High operational costs, coupled with aggressive investments in research and development, RD, have created a perfect storm that's making it difficult for D-Wave to turn a corner financially. But let's break this down further. Revenue growth of over $8.8 million might sound impressive on paper, but when you consider the context, it becomes clear why investors are nervous. The gap between revenue and profitability is widening, highlighting challenges common to tech-heavy industries. Companies in this space often pour vast sums of money into RD to stay ahead of the curve, but this approach can backfire if those investments don't translate into tangible returns. In D-Wave's case, surging operational expenses are eating away at their top-line growth, casting doubt on their ability to achieve sustainable profitability anytime soon. That said, there are some silver linings worth noting. For one, D-Wave boasts a current ratio of 43, which suggests the company is well positioned to meet its short-term obligations. This level of liquidity provides a cushion during turbulent times, allowing D-Wave to weather financial storms without jeopardizing day-to-day operations. However, their long-term debt remains a delicate balancing act. With a total debt-to-equity ratio of just 0.06, the company appears to be managing leverage carefully, avoiding the pitfalls of overburdening future earnings. Still, the question remains, is this cautious approach enough to satisfy skeptical investors? Another intriguing aspect of D-Wave's valuation is its price-to-book ratio of 9.12. On the surface, this figure seems high, prompting critics to ask whether the market is pricing in overly optimistic expectations about the company's future achievements. Proponents argue that the transformative potential of quantum computing justifies such valuations. But skeptics counter that hype alone cannot sustain a company indefinitely. This ongoing debate underscores the tension between innovation and financial discipline, a dynamic that defines not only D-Wave, but also the broader tech sector. Delving deeper into the financial statements reveals additional insights. Depreciation and amortization expenses came in at $507,000, raising questions about the lifespan of D-Wave's assets compared to their immediate capital needs. Meanwhile, capital expenditures totaled $749,000, reflecting the company's commitment to growth even as equity markets send bearish signals. With cash reserves exceeding $800 million, D-Wave clearly has the resources to pursue its vision, but how effectively they allocate these funds will determine their success or failure. One area drawing particular attention is stock-based compensation. As competition in the quantum computing space heats up, retaining top talent is crucial. By offering competitive packages tied to stock performance, D-Wave aims to maintain its edge in a rapidly evolving industry. Yet this strategy comes with risks, as excessive dilution could erode shareholder value over time. It's a fine line to walk, and one that requires careful consideration moving forward. So what does all this mean for the average investor? Well, the broader implications are significant. When the markets opened, D-Wave's stock experienced an immediate downturn exceeding 3%. This decline stands in stark contrast to bullish predictions based on the company's recent initiatives and technological advancements. Instead, widening losses are overshadowing D-Wave's progress, fueling caution among stakeholders who are increasingly focused on profitability. Analysts are closely monitoring whether the company's innovations can eventually outweigh its financial setbacks. This brings us to another critical point, the role of liabilities. Recent reports indicate that D-Wave's liabilities are increasing, reinforcing negative sentiment surrounding the stock. Investors are understandably wary, as rising debt levels can signal trouble ahead. Until the company demonstrates tangible returns on its investments, skepticism is likely to persist. After all, in the fast-paced world of tech, striking the right balance between promise and peril is no easy feat. In closing, D-Wave Quantum Inc. finds itself at a crossroads. Navigating the complex interplay between technological ambition and fiscal responsibility is no small challenge. Yet it's one that will shape the company's trajectory for years to come. As Tim Bowen, lead trainer with Stocks to Trade, aptly puts it, the best way to learn is by tracking trades, wins, losses, and lessons learned. Every trade has something to teach. For traders and investors watching D-Wave's journey unfold, this philosophy rings true. Whether you're a passive observer or an active participant in the market, D-Wave's pursuit of quantum breakthroughs serves as both an inspiring and cautionary tale. What do you think? Is D-Wave's current valuation justified, or is the market setting itself up for disappointment? Share your thoughts in the comments below. We'd love to hear your perspective. And if you're ready to take your trading game to the next level, check out Stocks to Trade's robust platform designed to keep you ahead of the curve in today's volatile markets.